PPT?
Yes, sir.
Okay, nice. At morning session today, we have discussed about risk, different types of risk. Now, here we have to discuss about risk and uncertainties. Here I have given few options that multiple possible outcome, probabilities can be estimated, at least one outcome may cause loss. Key characteristics, uncertain but measurable based on data or experience can be managed. Means we have seen that risk means we know what will be the output in the future. So we plan it before to take any actions. Example of risks, stock market investments, higher risk in warehouse, credit risk in lending. Stock market investments means where you invest your money in shares. Okay, the share market is always volatile. The share rate may be increase or decrease. So you may know the risk that you will get profit or you will get loss. So this risk is measurable and non-bias means expected risk that we can take in our business or organizations. Next is higher risk in warehouses. Means if there is fire in warehouse, what will happen? Our raw material or finished goods will be destroyed by the fire. But if we have taken insurance for that, we will be safe. Means we will get amount from the insurance company because of we have paid it insurance amount at the start of that company or every year, because we take insurance that is part of general insurance. There are two types of insurance. One is life insurance and another is general insurance. Life insurance is for our human, male, females, and general insurance for properties. For your knowledge, you may know there are four national general insurance companies and one life insurance company. Nowadays, there are so many companies in India collaborated with foreign countries to start that insurance business because India has best potential in insurances. Another is credit risk in lending. Means if your company is a finance company or a bank, or even you can pay your friends, colleagues, or relatives for their needs. But you should have to save yourself. But how you should have to save yourself? With taking few documentations like agreements, checks, and others. Because why? The person can deny that I have taken amount from you if you have paid cash amount to anyone. But nowadays, cash transactions are becoming very less. Most of the times, people are transaction getting transactions in by check system or by UPI systems. So all the transactions are safe. But in a few cooperative banks, what happens? They have not taken documentation from the lenders, borrowers. So the borrowers denied that we have taken loan. So they have not repaid that amount, and that's why in Maharashtra, so many cooperative banks and cooperative societies collapsed, bankrupted because of the planning of directors. So we must have to aware about these examples, that when will we lend money to anyone, we must have to take assured documents, legal documents. If we don't know how to make every transactions legal, we must have to go every transaction throughout our legal advisor or advocates, solicitors. What is uncertainty? We have discussed about risk management, but what about uncertainty? Uncertainty means future outcome are unknown, means unexpected occurrences, probabilities cannot be assigned. Key characteristic that not measurable, lack of historic data, difficult to quantify. Which types of uncertainty can be happen in our life? We have already faced a COVID pandemic. Due to COVID pandemic, most of the companies were stopped their production system, and so many health problems, health issues uh, due to COVID pandemic. And insurance companies also had to pay so many amount, because the person who have saved saved their life with insurance, medical insurance, term insurance, insurance companies has paid a lot of money to that cases in the COVID pandemic. So insurance companies also were in loss at the time of COVID pandemic. And due to not sale of goods, so many companies also closed or shut down in COVID pandemic. Now we have observed and maybe read news in the newspaper that in other countries there are situation like war situation is there. So what's happened indirectly, that will be effect on other countries also. Why? Because we are import and exporting goods from one country to another country. So their effect may be occur on our country also. Although the war is not in India, out of India, means abroad in foreign countries, but their effect will be definitely on our country. So the condition of war is uh, in in the uncertainty mode. Other accidents, different types of accidents, earthquakes, these are unexpected occurrences. So these types of examples are as the example of uncertainty. Here another example also given, that we have also discussed in the morning session, that new technology impact means, for example, we can take an example of an oil company, oil of groundnut. Groundnut used as the raw material to make oil from it. Uh, Previous companies was taking near about 4 kg groundnut to draw oil from it, and it may be up to 1 kg. Means you can guess that from 1 kg groundnut, you will get 250 gram oil. Okay. Nowadays, what's happened? There are new technology, new machines are available which can draw the oil from the groundnut near about 350 to 400 gram. Means where you have to use 4 kg groundnuts, now you have to use only 2.5 to 3 kg groundnuts for that. In this way, you can increase your profit also. Means your operation cost will be automatically less, which will be effect in the profit. Okay. In technology, we can also say that computer technology is also enhanced nowadays. We have used black and white computers, then P4 computers, then core to dual core computers. Later on, different types of i3, i5, i7, and now i9 generation also available. This can explain us technology is day by day changing. So R&D is there available in the technology, research and development. The speed of internet before 1 decade were very less. We were using broadband system, but nowadays the internet speed is also available in high level. We have used the internet speed in kbps, kilobytes per hour, but nowadays you have available speed from 2 MB to 50 MB. Means this technology and enhancement in technology is needed by the new generations and coming era. Political or regularity changes. Politicals means different types of parties can take over in India and our state level. Just we have finished, we have seen that the latest election completed, and we have also given our votes to the to select mayor. And what about regulatory changes? Governments taking new actions about GST and other laws. We have seen that there were GST rate of 28%, but in recess system, GST come down at 18% rate. Okay, this amendment done by government to bloom the market or to grow the market. We get this benefit of GST in Diwali festival. So in Diwali festivals, so many people have purchased the new things from the market, and in this way the market was growing. Consumer response to new products. Suppose you have launched a new company and you have so many hopes from your products that your product will be accepted by the consumer or clients. But what's happened? There are another companies with same products. Okay, means you are a competitor company. So before to use your product, people will think about trust, quality, rate, and all these things before to purchase any product. And people are always giving priority to the brand products, old products, which are already available in the market because of their tastes and rates. And if your expectation not fulfilled in the market about your product, what will happen? You will get losses because you have to sell your product on less rate, or you have to give few offers to clients. You have already seen there are different types of offers in the malls, super shops, that buy one get one, buy two get one. These types of offers are available in the market or super shops. So your product is totally depend upon consumer mind or psychology of the consumer, whether he will accept your product or reject your product. Means this is also in the mode of uncertainty. Huh? One thing is most important, that if your product is unique, which is not available in the market, then you can gain the market, you can get the profit, you can sell high level products in the market. Okay. Risk versus uncertainty. Risk measurable, probabilities known, can be managed. Means where risk is measurable, uncertainty is not measurable. Probability is known, and in uncertainty, probability is unknown. Risk can be managed or can be done in less level. In uncertainty, hard to manage because reason is unknown. Okay. I have also explained a few examples in the morning session, that if your accident is done, this is a uncertainty happened with you. Okay. And there will be losses of your car. You must have to pay payments to repair your car. Okay. But if you know you invested in the share market, you know that your share rate will be increased or decreased. Okay. So you will take the decision, or you can analyze the market, that which share may be increased rates and which share may be getting down in the future. So risk and uncertainty can be defined here in two ways. Uncertainty in achieving objectives. Risk are uncertain future events which could influence the achievement of the organization's strategic, operational, and financial objectives. The dimension of risk include the impact on an organization's reputation, even the loss of legitimacy from activities deemed acceptable to the community. Risk management is conference and performance. Directors continue to ask management and consults the questions, where is the organization's exposed? This arises from the ongoing conference burden of corporate governance. On the other hand, the less frequently asked questions, are we taking enough risk? These two questions always asked to high level authority, means CEO of the company. If you are the CEO of the company, you will be definitely asked these questions, which reflects a healthy focus on performance improvement. Risk management is thus an adhesive that joint performance with conformance. Global executives are launching major initiatives to improve their company's management of risk to drive performance. These initiatives focus on actively managing risks that must be taken in the pursuit of opportunity and ultimately profit, because the objective of every company is to get profit or wealth maximization. This new look at risk contrasts with the more common notion of risk management, which has concentrated on protecting the organization from losses through conformance procedures and hedging techniques. Such risk management tactics seek only to avoid the downside of financial loss. We will also discuss about hedging, that how to mitigate risk in share market. Today, boards expect that management will look at both risk assessment, understanding the potential upside and downside of actions, and the management of risk to raise the likelihood to success, reduce the likelihood of failure, and decrease the uncertainty of overall financial performance. Risk management, in the full sense, is about seeking the upside while managing the downside. On the form of seeking the upside, risk is inherent in a business, although the nature and extent may differ. Risk is as applicable to a small retailer as it is a multinational conglomerate. A company takes risk in order to pursue opportunities to earn returns for the owners. Striking a balance between risk and return is key to maximizing shareholders' wealth, while the latter, managing the downside, requires a combination of conformance and performance. To understand these two views, a brief review of what is occurring in the marketplace is helpful. Conformance. After the infamous excesses of the 80s and 1990s, have seen a great opportunity of frameworks or model to better control business management. Some of the highlights include the all-pervasive COSO report is the United States, Cocoa in Canada, Cadbury and Hempel in the United Kingdom, Commission Peters in the Netherlands, and the risk management standard in Australia. A more detailed review of the status of these developments is set out. If a common thread can be identified in all these models, it is the linkage between risk and control. Performance. Most of the focus in the various performance and conference frameworks mentioned above emanates from the view of risk as hazard or downside and related conformance. What about upside and value? What about the investor's perspective? Where is the linkage between pricing of the risk and return? When shareholder will take interest in your company, what will they check? They will analyze your performance, that how much return your company is giving from last years. So analyze will be done by our shareholders. Leading edge practice is building on the platform of conference to pursue the relationships that have always been implicit between risk and return and growth. Executive management are concerned with expanding shareholder wealth. The relationship that risk management has to improving performance and thus Shareholders value highlights the fundamental objective of managing business risk. Risk management is an integral part of business, and risk is good if commensurate with the adequate level of return. Management of general and the CFO in particular must closely link risk management, achievement of corporate goals, and reduce the volatility of outcomes to driver performance. Central to understanding shareholder value is an appreciation of growth, risk, and return. Example is given that academic research suggests there is significantly higher correlation between changes in underlying free cash flows and change in shareholder value relative to changes in EPS for a company, means earning per share. Free cash flow and economic profit valuation methodologies are built on explicit assumptions about growth, risk, and return, and are not reliant on relative measures or market determined multiples. For example, price earnings multiple. Cash returns, growth, and risk are the fundamental drivers of shareholders' value and provide a more comprehensive and accurate assessment of the underlying economies of the business. The EPS approach does not adequately reflect the risk and return drivers. One example is also there available there about yourself, that if you are studying the study of MBA, you may pass the exams. It's totally depend upon you. Although you don't know what will be the questions in the exams, okay? But you must have to study all the syllabus to give the best performance in the exams. So you will get the marks as per your study level. Okay, how deep study that you have done, you will get the answer after result. Means result will show your performance. Okay, that type is also known as a risk. Okay, about your study. If you will study entirely throughout the syllabus, you will get best mark, best CGPA. Otherwise, you will get marks only for passing purpose. Taking and managing risk is at the heart of shareholder value creation. Yet current approaches to shareholder value creation often emphasize growth and return while paying little attention to the specific risk inherent in implementing profitable growth strategies. Where risk is identified, many companies continue to rely on static financial risk mitigation strategies such as foreign exchange and capital structure practices formulated when the organization size and financial structure were vastly different. While the stock market has been rewarding companies for their success in creating shareholder value, new approaches are necessary to sustain current level of growth. Means you must have to keep regular ratio of your company, your organization to maintain the level of growth. Means you must have a sustainable development in your company. Okay, and customers, your stakeholder will observe your development. in the form of output that you have given to the shareholders. A handful of leading companies are demonstrating that a more dynamic approach to risk management is critical to delivering superior sustainable returns to shareholders. To this end, management must be willing to expand its approach to shareholder value by integrating a dynamic concept of risk into its existing focus on growth and returns. Therefore, these three elements are fully part of the integrated approach set out in this paper. The importance of the relationship of the management of risk to shareholders' value should not be underestimated. As management becomes more aware of the importance of risk, there is a progression along a broad risk spectrum to greater sophistication in risk management and appreciation of its linkage to shareholder value. This can be seen in the following examples from the recent global survey. It shows the steps companies climb as they move to value based management. In India, so many foreign companies also interested in finance also. General Electrical Company and others company are taking interest in India to get so many investments and to lend money to the company on big projects. The natural progression from managing the risk associated with compliance and preventions the downside through managing to minimize the risk of uncertainty in respect of operating performance, and then moving to the higher level of managing opportunity risk, the upside, which need to be taken in order to grow sustainable shareholder value. The more sophisticated approach. What is that approach? It allows better allocation of capital to risk and risk management initiatives. It supports better allocation of risk management resources. It provides better performance indicators and monitoring opportunities. Often annual measurement are inadequate and static. It affords some protection against effect executive liability and adverse publicity or attention from investor and other stakeholders. It supports better risk reporting throughout the organization. In order for this drive to performance to have practical application at a business level, two clear sets of answers need to be established. Okay, first is what are the drivers of value and how are they structured and managed? Second is what are the key risks associated with these drivers of value? At morning, I have given you a formula about 5W and 1H. That is, you should have to study the risk in the format of 5W plus 1H. That is, what what is the risk, where is the risk, why is the risk, whom is the risk, how is the risk, and when is the risk. Okay, so keep in the mind the answer to these questions can be formulated by mapping the process that drive value within the organization, and another is identifying and analyzing the business risk and establishing the appropriate responses that will have most impact on the value drivers. This approach requires and deliver an integrated approach to business risk management. To develop a capability in risk management that will create an instinctive and consistent consideration of risk and reward in day-to-day decision making. Planning, execution, and monitoring of strategy requires linking the value creating activities to the business risk profile and to the risk response or architecture. The rest of this paper is devoted to a more detailed analysis of the business risk continuum and the risk response or architecture. Shareholders understand value, the risk and return dimension, that is the pricing of risk. Do they understand risk and response? Shareholders and lenders entrust their capital to companies and their board of directors because they seek a higher returns than they could achieve from a risk free investment in, say, government securities. So many companies also investing in government securities, bonds published by government or RBI, Reserve Bank of India. In investment, we may have learned about different types of investment to secure our risk. Means so many take decisions about investments that to invest a amount in different ways to make the income risk rate lower and lower. How? Suppose you have to invest 1 lakh in share market, you must have to divide 1 lakh in 2 3 methods. Just like you have to invest 30 to 40,000 in share market, you have to invest 30,000 in bank FD, you have to invest 30,000 in purchasing golds or taking government bonds, that is secured and assured, and a remaining amount can be invested in getting other properties where you will get returns. Okay, this is a small example. You can use maximum amount for to compare this example. You can also take 10 lakhs, 1 crore rupees also. But to understand easily, I have given example of 1 lakh rupees. This implies that they expect board and management to demonstrate entrepreneurship and dynamism, that is to take risk. They expect that the risk will be well considered and well managed, and that the risk profile of the enterprise will be widely understood. Now we elaborating on the risk and response dimension. Shareholder value analysis addresses risk and return. How to identify an organization's risk profile. People also check the profile of the company before to investment in any institute or organizations. Okay, they always analyze last few decades study available on the internet or subsidiaries. The first steps towards clarity is to recognize that risk is most often used in several distinct senses. risk as opportunity. Am I audible now?
Yes, sir.
Okay, okay. Few incoming calls disturbing in these sessions. So I have rejected that calls. The greater the risk, the greater the potential return, and necessary, the greater the potential for loss. In this context, managing risk means using techniques to maximize the upside within the constraints of the organization's operating environment, given any limitations, through having to minimize the downside. Risk as hazard or threat is what managers most often mean by the term. They are referring to potential negative events such as financial loss, fraud, theft, damage to reputation, injury or health system failure, or lawsuit. The downside. In cybersecurity, there are different types of risks also available, just like defamations means to make the down credit of the owner of any organizations. Few rumors will be shared by the company of our rivals. In this context, managing risk means installing management techniques to reduce the probability of the negative event without incurring excessive cost or paralyzing the organization. A third view embraces the more academic notion of the risk uncertainty. This refers to the distribution of all possible outcomes, both positive and negative. In this context, risk management seeks to reduce the variance between anticipated outcomes and actual result. Means suppose you decided in the meeting that in this year we will earn a profit of 10 crore. This is your anticipations. But at the end of the year or financial year, what happened? You got only 5 crore profit. Means what happened? Your anticipation was of 10 crore, but you got the profit of 5 crores. Means you have not achieved that 5 crore profit. So you must have to study in the next year that what was the drawbacks where you not aware about market risk, other segments, and you are unable to get the profit as per your anticipation or your target. Each elements of the three-part definition of risk above broadly connects with one or more functions within companies. Although functional emphasis and management boundaries are inherently flexible, risk as hazard typically represent the perspective of manager responsible for performance activities, particularly the financial controller, internal audit, and insurance administrators. Every year, our company make an audit from our CA. Okay, so CA always give us the profit and difference between last year and current year profit. Okay, after that, we can publish that our balance sheet to the our shareholders or stakeholders. Risk as uncertainty is a governing perspective of the CFO and line management responsible for operations. Risk as opportunity often reflects the outlook of senior management and the planning staff who largely address the upside element of risk. These concepts underpin an organization's risk profile and can be illustrated in the terms of a business risk continuum. This was initially identified in pursuit of the upside. The new opportunity in the risk management are also available, but we must have to observe that new opportunities. Of the three aspects, most companies formally address hazards, yet senior management spends most of its time considering opportunities. Therefore, business process for risk profile identification and risk response must be linked to sustainable shareholders value. How to identify the risk? Identification is crucial stage in the risk management process and as depicted in the following examples, the range of potential exposures is vast, means impact on company risk profile, that is competitive pressure, powerful words, players and news, aggressive entrepreneurs increase the need for acquisitions and alliances and threaten hostile takeovers from investors. Growth in both managed and individual investment, plus greater global flexibility, demands more information and disclosures. New technology offers steps change in performance but brings new competitive threats and increase the investment cost. Globalization bringing uncharted new markets, complex logistics, global supply chain, and specialized local requirements, increasing regulations, trading blocks, environmental pressures, international tax reform, monopoly legislations, and corporate governance concern, political changes, continuing national and regional pressures, and unpredictable stakeholder behavior, financial volatility, international capital flows, currency and interest rate, volatility and complex derivations and hedging instrumentation. The Royal Bank Financial Group has a three-tiered framework to identify and analyze the risk facing the organization as whole. Each unit and branch uses a framework to identify the assess risk. Systematic risks are the political, economical, social, and financial risks over which an organization has very little control. This creates the environment within which the organization must operate. Management must be aware of these factors and how they affect different areas of the organizations. The, level 2 risk is these are factors and that the organization cannot control but can influence. The Royal Bank Finance Group identifies several level 2 risks, including competitive, reputational, and regulatory. Second, level 3 risk. These risks vary with each industry but can be generally viewed as risk that an organization can have a great deal of influence over. The Royal Bank Financial Group identifies level 3 risk as credit, market liquidity, technology, operating, and people. Accepting that risk is any future event influencing the achievement of a business objectives, it follows that risk identification should start with the consideration of the organization's critical objectives. Risk identification and definition should be approached in a systematic way. Risk management relationship focuses mainly on risk, converts uncertainty into risk through research, data collection, expert judgment, scenario analysis. Means you can mitigate the uncertainty with risk, means expected profit or loss assumptions through research, means for that you must have to analyze every company data which is available on the websites. Okay, so for that you should have to collect that data. Expert judgments, means there are few market consultants which give the best judgment about the market, that what will be the situation. They prejudge the market, that whether the market will be boom or maybe getting down. Scenario analysis should be there. For that you can also use Excel for scenario analysis. Okay, frank net definition about risk and uncertainty, that risk is measurable uncertainty, whereas uncertainty is unmeasurable uncertainty. Okay, summary: risk equal to measurable chance of loss, and uncertainty is unknown outcomes. Risk management identifies and controls risk. In this way, today we have discussed about risk versus uncertainty. I would like to ask every student that yet how many students have not given or submitted their research title. Tomorrow will be the last day to submit your title in the college. So meet me in the college to discuss about your title and objectives. Okay, note that thing. So today's session is over. Okay, our next session will be on tomorrow morning. Thank you. Thank you to all.